For millennia, gold and silver have symbolized wealth, power, and permanence. From ancient pharaohs to pirates, these metals have always been prized as stores of value. Their allure is universal, a language of worth that transcends cultures and time. Gold doesn't rust or corrode, it's eternal. A Roman gold coin looks nearly the same today as it did 2,000 years ago. Silver, though it tarnishes, shines with a brilliance that's captivated civilizations. Both are rare, durable, and beautiful. Ideal for trade and money long before paper currency. When empires fell or currencies collapsed, people turned to gold and silver for stability. Holding a gold coin meant holding certainty in uncertain times. This trust is deeply rooted, shaping how we view these metals even now. Despite modern financial systems, gold and silver remain the bedrock of our concept of real money. Their stories are woven into the rise and fall of kings and empires. Understanding their timeless appeal is key to grasping their ongoing importance. In a world of digital money and economic uncertainty, their allure endures. Gold and silver's legacy is as relevant today as it was in the ancient world. For much of modern history, money's value was anchored to gold. The gold standard meant you could exchange paper currency for a fixed amount of gold. This system kept inflation in check and currencies stable. International trade flourished because exchange rates were predictable. Governments' power to print money was limited by their gold reserves. Fort Knox became a symbol of national wealth and security. But the gold standard was rigid. In times of crisis, governments needed flexibility to print money, but the system held them back. This tension led to its eventual collapse. The gold anchor provided stability, but sometimes nations needed to break free to survive. The end of the gold standard set the stage for a new era in money. In 1971, the US cut the dollar's last tie to gold, ushering in the era of fiat currency. Gold and silver were suddenly free to float, their prices set by the market. Gold soared, signaling doubts about paper money's true value. The metals became barometers of fear and uncertainty, not anchors of stability. Price swings grew dramatic, booms during crises, busts when confidence returned. Gold and silver became volatile assets, not stable measures of value. Governments gained new power to manage economies, but lost a key check on inflation. For individuals, preserving wealth now required vigilance and strategy. Trust in money was no longer automatic. You had to manage risk yourself. Many turned back to gold and silver, not as currency, but as insurance. The post-gold standard world is defined by uncertainty, and the metal's role as a hedge. Their value now reflects the world's anxieties and hopes. Today, gold and silver trade in a digital world of lightning-fast transactions. Futures, options, and ETFs let anyone buy or sell metals with a click. High-frequency trading and algorithms drive rapid price swings, sometimes disconnected from physical supply and demand. A single digital trade can trigger a cascade, sending prices soaring or crashing in minutes. Most traders never touch real metal. They're speculating on price, not owning gold or silver. This speculation adds volatility and risk. The digital market is liquid and accessible, but also unpredictable. Physical and digital markets now coexist, often moving in different directions. For investors, understanding both worlds is crucial. The ancient stability of gold and silver now meets the chaos of modern finance. Prices can swing wildly, but the metal's allure remains. Navigating this landscape means balancing tradition with technology. Even safe havens like gold and silver can fall sharply in price. Strong economies and rising interest rates often trigger these drops. When investors can earn more from bonds or stocks, gold loses its appeal. Higher rates make holding non-yielding metals less attractive. A strong US dollar also dampens global demand for gold. Silver, with its industrial uses, can drop alongside gold or due to shifts in manufacturing. Sometimes all assets are sold in a panic, dragging even gold down temporarily. These drops are normal market cycles, not signs of doom. For seasoned investors, volatility is expected, opportunity, not disaster. Understanding the reasons behind price moves helps avoid panic. In precious metals, patience and perspective are key. When digital gold prices plunge, coin shops often see a surge in buyers. On trading screens, panic selling rules, but in the real world, people see a sale. Phones ring off the hook as buyers rush to grab physical metal at lower prices. This demand can push up premiums, so coins may not get much cheaper even as spot prices fall. The paper market is driven by traders chasing quick profits. The physical market is about long-term value and tangible wealth. Coinshop buyers want something real in their hands, not just numbers on a screen. Dealers may hold inventory to meet demand, caught between falling wholesale prices and rising retail interest. This divide shows that for many, gold and silver are more than investments. They're real, lasting assets. In times of volatility, the physical market tells a different story than the digital one. In the world of precious metals, there are two main buyers, investors and collectors. Investors, or stackers, focus on metal content and low premiums. They want ounces, not art. They buy when prices dip, aiming for long-term wealth preservation. Collectors seek rarity, history, and beauty, sometimes paying huge premiums for unique coins. For them, a coin's story matters as much as its gold or silver content. The spot price may drop, but rare coins can hold or even gain value. Sometimes investors become collectors and vice versa. This overlap explains why some coins trade near melt value, while others fetch high prices. Value in precious metals isn't just a number, it's shaped by purpose and perspective. Whether you seek wealth or history, gold and silver offer both.